IFRS, or International Financial Reporting Standards, are issued by the IASB to create a single set of high-quality, global accounting standards. This common language for business ensures financial information is understood worldwide, fostering trust and transparency. In today's global economy, cross-border operations and investments demand comparable financial data. Without IFRS, comparing companies would be like comparing inches to centimeters, confusing and unreliable. Adopting IFRS enhances transparency, accountability, and economic efficiency, making cross-border investment easier and reducing companies' cost of capital. Ultimately, IFRS sets a high benchmark for financial reporting, strengthening the integrity of the global financial system. IFRS 5, Non-Current Assets Held for Sale and Discontinued Operations, is a crucial accounting standard that guides how companies must account for assets they intend to sell, as well as for business operations that are being discontinued. This standard ensures that when a company decides to sell a significant asset or close down a part of its business, the financial reporting is clear, consistent, and transparent for all stakeholders. It covers not only the sale of individual assets but also the closure or sale of entire business units, divisions, or subsidiaries. This can include anything from selling a factory to shutting down a retail branch or even discontinuing a product line. The main objective of IFRS 5 is to improve comparability and clarity in financial statements. It does this by specifying exactly how companies should measure, present, and disclose these assets and discontinued operations, so that investors and other users of financial statements can easily understand the impact of these changes. IFRS 5 applies to all recognized non-current assets and disposal groups, except for certain financial assets, deferred tax assets, and assets arising from employee benefits. This means that most tangible and intangible assets held for sale, as well as groups of assets and liabilities to be disposed of together, fall under its scope. By following IFRS 5, companies ensure that users of their financial statements receive relevant and timely information about significant changes in the company's operations or financial position. This helps investors, creditors, and regulators make better decisions. The key distinction under IFRS 5 is that these assets are no longer being used to generate income through ongoing business activities. Instead, they are classified as held for sale, meaning the company expects to sell them in the near future, and they are measured and presented differently in the financial statements to reflect this change. Non-current assets such as property, plant, equipment, or intangible assets like patents are resources that a business expects to use for more than 1 year in its operations. These assets are not intended for immediate sale in the ordinary course of business, but rather, they help generate revenue over the long term. Examples include office buildings, manufacturing machinery, delivery vehicles, and even software licenses. They are essential for the day-to-day functioning and growth of a company, forming the backbone of its productive capacity. However, when a company decides to sell one of these assets, and the asset meets specific criteria, it is reclassified as held for sale under IFRS 5. This means the company's main intention has shifted from using the asset in its operations to actively seeking to sell it, and management is committed to completing the sale within a year. For an asset to be classified as held for sale, it must be available for immediate sale in its present condition, with no significant improvements or repairs required. The sale should be highly probable, and the asset should be actively marketed at a reasonable price compared to its current fair value. Once classified as held for sale, the carrying amount of the asset will be recovered primarily through its sale, rather than through continued use in the business. This reclassification signals a major change in how the asset is expected to provide value to the company. For example, if a delivery company decides to sell an old van that it no longer needs and begins actively searching for a buyer, the van is reclassified as held for sale. The company must be committed to selling the van, and the sale should be expected to occur within a year from the date of classification. This reclassification triggers a different accounting treatment under IFRS 5, requiring the asset to be measured at the lower of its carrying amount and fair value less costs to sell, and presented separately in the financial statements for greater transparency. IFRS 5 sets strict criteria for classifying assets as held for sale. Management must be committed to a formal, authorized plan to sell, and the asset must be available for immediate sale in its current state. The company must actively seek a buyer, and the sale should be highly probable, usually within 1 year. The selling price must be reasonable compared to fair value, and the plan should not be likely to change. These requirements prevent premature or inappropriate classification. Only when all criteria are met can an asset or disposal group be classified as held for sale. When a company decides to sell an asset, it must first classify it as held for sale, according to accounting standards. This classification is not just a label, it triggers a specific way of measuring the asset's value on the balance sheet. From this point, the asset is measured at the lower of its carrying amount, which is essentially its book value, or its fair value less costs to sell, often abbreviated as FVLCTS. This means the company must estimate how much it could realistically get for the asset in the current market after subtracting any direct costs required to make the sale, such as broker fees, legal expenses, or commissions. Fair value is determined by what a willing buyer would pay in an orderly transaction, not a forced or rushed sale. The costs to sell are only those that are directly attributable to the sale itself, so things like advertising, legal paperwork, and agent commissions are included, but general overheads are not. This careful calculation ensures the asset is not overstated on the books. Once the asset is classified as held for sale, depreciation on that asset stops immediately. This is because the company no longer expects to recover the asset's value through its ongoing use in operations, but rather through its eventual sale. The focus shifts from using the asset to preparing it for sale. If the fair value less cost to sell is lower than the asset's carrying amount, the company must recognize an impairment loss. This loss is recorded in the profit or loss statement, reflecting the reduction in the asset's value and ensuring the financial statements remain accurate and transparent for stakeholders. However, if the fair value less costs to sell later increases, the company can recognize a gain, but only up to the amount of any previous impairment losses. This prevents the asset from being valued higher than its original carrying amount before it was classified as held for sale, maintaining a conservative approach in financial reporting. By following this approach, companies ensure that assets held for sale are reported at values that are both realistic and recoverable. This process not only protects investors and stakeholders from inflated asset values, but also provides a clear and honest picture of the company's financial health as it prepares for future transactions. A discontinued operation is a major business component, like a division or geographic area, that's been sold or classified as held for sale. It represents a strategic shift, not just a routine asset sale. The component must be clearly distinguishable operationally and financially, with separate assets, liabilities, income, and expenses. For example, selling an entire division qualifies, while selling a single machine does not. The disposal must have a major effect on the company's operations and financial results. Classifying discontinued operations signals significant changes in a company's future direction. Assets held for sale are shown separately as current assets on the balance sheet, with related liabilities also presented distinctly. Discontinued operations are reported separately in the income statement, usually as a single post-tax amount. This clear presentation helps users see the impact of major changes at a glance. IFRS 5 also requires detailed disclosures in the notes, explaining the nature, timing, and financial effects of these sales or closures. By highlighting significant changes, IFRS 5 enhances transparency and comparability across companies and periods. This clarity helps investors and stakeholders make better decisions about a company's future.